Hello, and welcome to Portfolio Matters. Those of you who have watched our introduction to the podcast will know that we adopt a top-down approach to investing and like to invest in cycles, because if we know where we are in the cycle, we can then have an idea of how commodity prices and share prices will go as a whole, which makes the task of asset allocation much easier. And as we promised in the opening introduction, we would intend to update on the cycles once a month. So this is the February cycle monitor. And before we get into it, Richard will do the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, first up, the inflation cycle. Now, last time we looked at this, we had the inflation clock at about 7:30. And frankly, I think everywhere we look, we are seeing signs of nascent inflation. If you look at commodity prices, they are all shooting up. If you look at output prices as measured by the output from Chinese factories, those have now turned positive. And freight rates around the world have quadrupled in the last 6 months. So I think there is an inflation surge coming through. And if you look at the actions of central banks and of governments, they put a lot of money into the hands of consumers, which we know they have saved. And as soon as they're able to spend, I expect them to do so. And I expect to see a strong recovery when the COVID restrictions end, leading to very strong demand growth and inflation. Richard?
Yeah, I think certainly the change that we're seeing in commodity prices is going to feed through into pricing at the till, as it were, in due course. Everybody is saying that there's a huge amount of cash sitting on the sidelines because people have been saving and not spending. And I know that is to an extent true. I'm not sure that it is all going to come out in a massive surge in the way that some people expect. For two reasons. Everybody seems to be expecting it, and normally when everybody expects something in the market, something else happens. But the other thing is, there's a lot of financial damage being done to individual families' accounts. And one of the lessons of coronavirus is a salutary lesson, which is make sure that you have something to fall back on. So I'm not sure that we're going to come out of this with the same spending pattern that we went into it with. That's the caveat that I put on there.
Okay, I take that. I would say that it's been a K-shaped recovery, and that middle class people and the upper class have done much better than working classes in insecure jobs.
Yeah.
But it's incontrovertible that in aggregate, consumers have a lot more savings than they did beforehand, because the government has acted to maintain incomes, and people just haven't had not much to spend it on, frankly.
Yeah, I would agree with that, Keith. I think the top few percent, it's irrelevant. They probably haven't really changed their spending patterns anyway. It's the middle income people who have saved some money. My point is, are they actually going to go out and spend it, or are they going to go out and be careful because they're worried that this isn't over or something similar will happen? And I'm not saying we're not going to have inflation, actually, but I'm not sure that we're going to get this great splurge that everybody is anticipating.
Sure. But to add to your argument, I would say that it is difficult to envisage very strong inflation when unemployment is high and unemployment remains elevated. So therefore, where are the labour price pressures? And labour prices are the largest input into goods and services. So without price pressures from wages, how do you get big levels of inflation? I mean,
well, I think there's a couple of things. I mean, we're getting to the point, I guess, in this debate where there are all sorts of things that could happen. So we've got a great deal more concern now about national supply chain security than we had 12 months ago. And one of the things national supply chain security means you don't outsource everything to cheaper countries.
Yes.
That obviously puts up the cost. It puts up everybody's costs, and it means you're using your indigenous labour as opposed to cheaper labour elsewhere. So you can see that that is going to cause some cost push or labour inflation inevitably.
Yeah.
So I think I mean the other, the real concern also is we end up with some sort of stagflation, isn't it, where there's so much debt around that the debt drags the economy down, but we've got rising prices for a number of reasons, and that would be a very unpleasant sort of conjunction of two events.
Well,
I don't know what's going to happen,
but that's all for the future, Richard. I mean, right now, if we look at the dial where we are, I think you see inflation just picking up from very low levels, and we are in the moving into mild inflation.
Yeah.
And in that situation, I think the recommendation to have equities, index-linked gilts, and real estate and real assets is probably correct. And actually, I've implemented this by cutting down my gold and moving into equities, including gold equities.
Yeah, I think there's, I mean, the other thing, obviously, we are currently moving into what we think is going to be the mild inflation era. I agree. There's one of the things that happened in the hyperinflation of Germany was that stock market, the prices of shares went up, and they went up and they went down, and they were incredibly volatile. But in some instances, had you invested in the stock market or the right shares, you made a great deal of money during the hyperinflation of Germany. Now, I suspect that there are some people currently investing in the stock market because they think that if we have inflation, the stock market will do well. But if you look at what happened in the 1970s, people invested in the stock market didn't do well. And the danger is that we present, not we personally, but the financial community, if you like, presents a panacea that if you invest in this and that, then you'll be okay during inflation. And if you move into high inflation, it's bad for everybody, pretty much.
No, I agree with that. And I think, but I very strongly think you have to be nimble. Because if you look back to the Weimar hyperinflation, in the long run, people who held equities during the Weimar inflation did much worse than holding gold, but much better than holding cash, because the costs of hyperinflation are huge and it makes it very difficult to run companies. But at least they are real assets. If you look in the 1970s, then equity prices were astonishingly volatile. And the type of inflation you had in the 1970s, so oil price inflation, and then labor inflation, they really squeezed company profits. So again, that type of inflation was quite poor because companies did not have the power to price on the rises in input prices to consumers. So I think a lot depends on what sort of inflation you get. And also, if you look at the 1970s, if you got out at the right time and got back in, you had the chance to make a lot of money, but you had to be nimble.
Yeah, I agree with that, Keith. I think there are things that I think it's very dangerous to sit on a rule and say, if I follow this rule, I will be okay. I think you have to be very alert to what's going on. And I think you have to listen, podcasts widely, read widely, and understand that inflation is a malign, in my view, is a malign event, and it's very easy for people with modest savings to get wiped out by it.
Yeah. Okay. Moving on, the business cycle. Well, once we are still in lockdown, as you can probably tell from the fact that Richard and I are stuck in our offices and unable to do this in person over a cup of tea. So
in my kitchen, Keith, but yeah, take your point.
But actually, you know, manufacturing is recovering strongly. China is going great guns, and we are slowly coming out of this. You know, unemployment rates in the US are, new unemployment claims are falling. And as soon as we get out of lockdown and we're moving towards the end of it with the vaccination programs, then I expect the economy to take off. But right now, we're not far from trough.
Yeah, I think, so my comment there, Keith, would be that I think if we just sort of go back to late February, early March, around when people were starting to get scared by the pandemic, it was going to be over by the summer.
Yeah.
And then it was going to be over by the autumn, and then it's going to be over and now it's going to be over by this summer. And I don't buy that. I think that things will be better, but we know we have new variants coming through. We know that there will be a degree of loss of effectiveness by vaccines against various new variants. It's just going to happen. And so we know that we're going to be fighting this battle against coronavirus for many years to come. And we will, I think, probably be on a sort of gently sloping upward line, but we're not going to have a sudden, thank goodness it's all over moment. So the difficulty with that is it's actually very difficult to project what might happen to the expansion, how it might occur, which sectors it might occur in.
Yeah.
And right now, you know, the UK government has said don't book your holidays for the summer. And so clearly that damages leisure companies. But if the UK government comes out in 2 weeks' time and says it's okay to book your holidays, then the reverse happens. But then everybody flies off to Southern Europe, and suddenly Southern Europe has a problem, and they say don't come here.
Yeah.
So there is a huge amount of uncertainty over it, and I think that we have to acknowledge that this is going to take a long time to get over, and therefore you want to be in sectors that they might be exciting. You might think, oh, I can invest in a cruise company and triple my money, but you might lose most of your money when it goes bust.
Yeah.
And there are some sectors that are going to be hugely volatile and other sectors that aren't. And my inclination would be to have relatively small holdings in the very volatile ones and go for the ones that are likely to be more stable.
Right. Well, my approach is obviously to have quite a lot in the really dodgy stuff, in the expectation that you're going to make a mint when finally we come out of this.
Yeah, but you know that, Keith. You know what you're doing.
Yeah, well, in the meantime, expect some volatility. But then you have a podcast where you can complain about it and get it all off your chest.
Yeah.
Anyway. So, but when we look at the business cycle, I think we are at the beginning of the expansion. And as Richard says, the how long this expansion lasts and how quickly we go round this dial is very much open to debate. But I think where we are on the dial is the beginning of the expansion.
Yeah, I agree.
Okay, moving on. So Richard has very kindly produced a couple of charts on industrials and where we are in the commodity cycle. Richard, do you want to talk these through?
Yeah, thank you, Keith. So this is a graph of the CRB Raw Industrials Index. At the bottom, it's a basket of 19 commodities, 39 allocated to energy, oil and gas, 41% to agriculture, 7% to precious metals, 13% to industrial metals. So it's a broad measure, a relatively broad measure of commodity prices. And obviously, back in 2010, it was at around about 650, dropped to 400 in 2015, 2016, and it's now on a steep rise. In fact, I was looking at it, eyeing it up. The rise now is the same steepness as the rise in 2010 was. And it's gone up, what, 30%?
Yeah.
In 8 months. So this is bound to feed through into inflation, as we discussed a few minutes ago. Mm-hmm. And the question is, why is it happening? I'm not sure anybody is. There's clearly an element of production has been squeezed out by coronavirus slowdowns and shutdowns and so forth. There's an element of probably Chinese stockpiling of copper and oil and quite possibly other materials. People are becoming more nervous about the financial conditions generally, the amount of money printing, which gives rise to the precious metals increase. And the question, I suppose, the other question is this a speculative increase, or are underlying production costs going up? Because if it's speculative, at some point, prices will drop back down. If it's underlying production costs and possibly production levels not keeping up with demand, then you would expect the price increases to either continue or be sustained. What do you think, Keith?
Okay, to partly answer your question about what's causing it, I think one of the things that's going on is that consumers have money, but they can't spend on services, so they're spending on manufacturing goods, manufactured goods. So you'll see that Chinese manufacturing output is doing very well, and the main symptom of this is the massive increase in freight rates. If you look in our last weekly update, you'll see that international freight prices have quadrupled, and it's very difficult to get a container to move goods around the world. So what is happening is that people are buying goods instead of services, and that means they need inputs, and commodity inputs have had their supply disrupted over the last year by COVID, and so there is currently a shortage. Now, that feeds through to, yes, there's obviously speculation, because when speculators see anything, the price going up of anything, they buy it. But also, the question is whether this is temporarily caused by the fact that mine production has been disrupted and prices will come back down when mine production normalizes, or whether the increase in manufacturing output will continue to outstrip supply. And I don't think we know yet.
Should we take a look at the next graph, Keith?
Sure.
So this is US private investment in mining exploration, and I think you may have seen it last week. But obviously what's happened is the investment in mining exploration has been on a pretty much inexorable downward trend since the 1950s, with a spike in 1980. And that inevitably, I guess, leads to a slowly tightening supply. And so the thesis that one of the thesis of the reason for the commodity prices going up in general is because there's been a shortage of exploration, and therefore there is now a shortage of active mines, is borne out by this level of investment. If that were the case, then the increase is sustainable and will quite possibly continue for a number of years until the investment cycle catches up with demand.
Well put. And that brings us neatly onto the cycle. So, as Richard says, the commodity cycle is essentially a capital cycle. So when commodity prices are very high, everyone invests in mines. And then, a few years after that, a whole flood of supply comes on the market, which destroys prices. This is particularly the case in the oil market, which we have a separate dial for. But as Richard has just said, that the investment in commodity mines and capacity has been running at very low levels, particularly since the last crash in 2011. And investment in mines that was made then may well be coming on now, but going forward, there will be a dearth of opportunities as a result of the lack of investment over the last 5 years. So where are we now? Well, I would say that, prices are rising and rising quickly, and you see a much more interest in the mining sector as a whole, but we are early in the business cycle, and any investment in mines now or exploration will not feed through to a working mine for 7 years.
Yeah.
So we are very much in the early stage of the commodity cycle.
Yeah, I would agree. And what that means, if we're right, it means if you currently hold equities in commodity producers, don't sell. It would mean hold on to them for a number of years, because this is only just beginning. It's not going to peak for a number of years.
Yeah. Now the reason I put the needle on this dial quite so far round is I think the prices, I'm not sure how much further prices can go. Whereas if we just looked at the where the needle should be in terms of the capital cycle, I'd put it pretty much near the bottom. But I think prices have moved beyond that now. So I would be more cautious about investing in some of the frothier commodities, like, for example, rhodium or palladium, where I think the price is already incredibly elevated. And I wonder how much further the price can go, there
are many cycles within this cycle that aren't actually following quite the same timing.
Yeah. Okay, so finally, the oil cycle. Now, the oil cycle is something I have played over the years and has made me a decent amount of money. However, right now, the oil market is an artificial market in that OPEC hold the balance, and they have taken about 7 million barrels out of the oil market, which means they are in control. So it's an artificial market. But with those provisos, inventory levels are moving back to normal. They're now almost within their normal range, and they're almost back to the levels they were at in late 2019, early 2020. And the change in inventories is every week you are seeing large inventory drawdowns in the US. Now, if that continues, then that is very bullish for oil prices. But in order for that to continue, OPEC must maintain discipline and not increase their production. And historically, rising oil prices has always been very bad for OPEC self-discipline.
Can I ask you a question on these dials, Keith? We've got inventory levels. On the right-hand side, is 12 o'clock, is that high level?
12 o'clock would be when, inventories are very high.
Right.
And so, essentially you're running it. If you remember a few years ago, when there was the last oil crisis and shale oil had been massively producing, then inventory shot up, and actually there was talk about running out of storage space.
Yes.
Actually, this was actually earlier in the year, in March,
Yeah.
sorry.
And oil
March
tankers are
last year.
sitting as floating oil storage platforms.
Yeah. Then, when it gets to that stage, then there's nowhere to put the oil. I mean, and prices will completely crater. I mean, if you remember back to the WTI price going to -40,
Yeah.
I mean, that was caused by the futures expiry, and the WTI contract has a physical delivery. So basically, if you bought the WTI futures contract, you were going to get a barrel of oil.
Yeah.
And there's nowhere to put it. Nobody actually wanted this. So that's when it's sell. Buy is when the inventory levels are low. Now, a great buy would be when they are below normal. Yeah, but they're not below normal.
Right.
So hence the dial is moving back towards buy from sell levels.
Right.
Rather than, being at its absolute bottom.
Okay.
Okay, so the last dial is the 5-year investment view. And obviously, the last year has seen a total collapse in investment. And it's worse than that, in that BP, for example, has essentially slashed its entire exploration team. So going forward, there's going to be very little exploration. Now, we will go into this further in the weekly update, but if you look at the consumption of oil on an aggregate level, there's been absolutely no indication of a decline in demand on a multi-year view. Essentially, demand in emerging markets is growing quite strongly. And although there has been growth in renewable energy, overall, humanity's demand for energy keeps on rising at a strong pace. And although there has been growth in renewables, there has been no decline in the usage of fossil fuels. And if you believe that going forward, that trend will continue, or even that we will continue to use oil, then we are going to face a shortage of oil quite quickly.
Yeah. I think that's interesting, Keith. I read yesterday that Germany is in a spot of bother at the moment because it relies to a large extent on solar energy and wind energy for its electricity production. Its solar panels were covered in snow and there was no wind, and it was having to burn coal and oil in order to generate electricity. And that just exemplifies the issue we have with trying to move entirely to renewables. Also, we have a lot of countries with large young populations who are moving towards a standard of living that we have, and that is a very energy intensive activity. And the third thing is there's a relationship between the complexity of society and its energy consumption, and it's not linear. So if you double the complexity of society, you quadruple, for example, the energy consumption. And our society is becoming progressively more complex. And you just have to look at Bitcoin miners as an example of an energy add-on that wasn't there 10 years ago.
Yeah.
So it's a fallacy that we can use less energy. We will always be needing more energy, and it's a fallacy that we can move away from fossil fuels in the next 2 years, for example.
Yes,
it just
exactly.
isn't going to happen. The question is, to my mind, if you own shares in, say, BP, and the oil price spikes, what do you do when the price of your shares in BP spikes? Do you sell because that's the last spike, or do you hold because there's going to be a more sustained increase? I don't know.
The answer to that question, Richard, is you sell, because a spike in the oil price destroys economic activity. And actually, if you look at the causes of all the big recessions, a spike in the oil price has been associated with a recession coming quite quickly, which
So,
will
so the
destroy
last
demand and destroy the price.
the last thing we need now, then, Keith, is a spike in oil price coming on the heels of COVID.
Good point. Yes. Well, watch this space.
Yeah,
Because frankly, have you seen the oil price?
yeah, I
It's
know.
shooting back up. But the thing is, Richard, I would not worry about this in the short term because OPEC are completely in control of the oil market. And if the oil price starts to rise above comfortable levels, they will just open the spigots, and they've got a lot of capacity.
Yeah.
And as long as they have capacity, you don't need to worry about the oil price going too high.
Yeah. Okay. Interesting, Keith.
Okay, so I hope you enjoyed that. We will try and do that on a monthly basis, and though obviously these cycles play out over years. Now, in summary, I would say that we are saying that you should be long equities, commodities, and oil, and possibly index-linked gilts and assets, real assets such as property. And you should be avoiding bonds.
Yes.
Richard?
Avoiding bonds and avoiding bond-like equities, in theory. Although
Yes.
I think trying to predict what bond-like equities such as Amazon and Zoom and
Oh, yes.
trying to predict what they're going to do and Tesla is impossible, and I'm not.
So what you're saying basically is that you should be within your equities, you should be switching from highly priced growth stocks to more value stocks and cyclicals.
And asset-based stocks as well.
Yeah. Okay, well, thank you for watching. I hope to see you again soon. I hope you'll press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.